48 hours. That's how long it took for one man to lose $20 billion. Not a fund, not a bank, one person. And almost nobody saw it coming. This is ChartHustle. Let's talk about the $20 billion Vanishing act that crashed through Wall Street like a wrecking ball. His name was Bill Hwang, a Korean-American investor operating from a single office in New York. He ran something called Archegos Capital Management, a family office. Basically a private fund for his own money. Outside of finance, Hwang was invisible. No interviews, no public profile, he didn't need one. By 2021, he was controlling over $100 billion in market exposure. 100 billion. The problem, almost nobody knew his name. Hwang had a secret weapon called total return swaps. Here's what they do. You don't actually buy the stock. You make a deal with a bank. The bank buys it. You agree to pay the bank whatever the stock gains, or lose whatever it drops. The bank takes a fee. What this means in English: you get all the profit if you're right. You get all the loss if you're wrong. But you do it on borrowed money. A lot of borrowed money. Hwang turned $10 billion of his own capital into $100 billion of market bets. 10, 2, 1. Leverage. That's not strategy. That's concentration. That's danger. Hwang stuffed almost all of that leverage into a handful of stocks. Viacom CBS, Discovery Communications, Baidu, Tencent Music, VIP Shop. A few tickers, massive positions, all in the same sector bet, media and tech. No diversification, no escape hatch. The moment any of those stocks moved against him, the entire structure would unwind at once. Everyone watching the same position, everyone watching the same exit door, same direction out. And on March 22, 2021, the door slammed shut. Viacom CBS announced a seasoned equity offering. Fresh shares hitting the market, existing shares diluted. Price pressure. Hwang saw it coming. He panicked. March 23rd and 24th. He dumped nearly $1 billion into Viacom CBS and the other stocks. A desperate move, buying into falling momentum, trying to prop up prices through sheer capital force, trying to control the market. It didn't work. By late March, prices were falling. And when prices fall on leveraged positions, the math turns brutal. Hwang needed to post more collateral, margin calls, daily, bigger each time, from Credit Suisse, from Nomura, from other banks holding the other side of his swaps. They wanted protection. They wanted their money back. March 26th, Archegos couldn't pay. The margin calls exceeded all liquid capital. Game over. The banks didn't negotiate, they liquidated. Imagine holding the same stock through 10 different leverage machines. Now imagine all 10 trying to exit at the same moment, the same door again, the same direction. All that hidden exposure, all that invisible size, hitting the bid at once. The banks started dumping shares. Viacom CBS, Discovery, Baidu, all of it. Billions of dollars in sales in hours. Not auctions, not patient selling, emergency liquidation. Every sale pushed prices lower. Lower prices triggered more margin requirements from other banks. They liquidated too. A cascade. A death spiral. In 48 hours, Hwang lost $20 billion. Credit Suisse alone lost $5.5 billion. Nomura lost $2 billion. Other banks split another $2.5 billion. Total losses to the banking system, over $10 billion. For years, Hwang walked free. Then in 2024, the weight came down. Federal conviction, racketeering conspiracy, securities fraud, market manipulation, wire fraud. 18 years in prison. $9 billion in restitution. But the damage, it goes deeper than his conviction. Here's what Archegos teaches the retail trader who actually has risk discipline. Leverage hides concentration. Total return swaps hide exposure. Dark pools hide size. And when you stack leverage on top of concentration, on top of opacity, you're not building a position. you're building a dynamite warehouse. Hwang thought he was isolated. Private capital, discrete banks, no SEC scrutiny. He was wrong. $100 billion of exposure doesn't stay quiet. The market finds it. Friction costs are real. Liquidity is an illusion in a crisis. And the moment your counterparty decides you're a liability instead of an asset, they don't fight for you. They fight against you. If you ever catch yourself thinking, nobody's looking, or nobody knows my size, that's when you're closest to blowing up. Real trading isn't about the biggest bet you can hide. It's about the smallest losses you can take. Diversification, position sizing, transparency to yourself, and enough margin buffer that a margin call never happens in the first place. Hwang had $10 billion. He could have made 5% a year for 30 years and died rich. Instead, he chose leverage. He chose concentration. He chose opacity. And in 2 days, it was gone. This is why position sizing matters. This is why diversification matters. This is why the best traders are paranoid about hidden leverage in their own portfolio. The only exposure you can control is the one you know about. Subscribe to ChartHustle for more patterns that kill traders. And remember, the market doesn't care who you are. It cares what you did with your leverage.